Can you still hear me? Can you still hear me?
Yes.
Yeah, that's okay.
Yeah, I can hear you.
Let me just go ahead and share my screen now, so everything makes sense. Um, can you see my screen?
Yes.
All right, that's decent. Okay, so in our last module, we spoke about supply and demand levels. Um, prac- Practically going over how you can make sense of it, how you can wrap your mind around it, and then subsequently what to be looking out for whenever you have this levels around. And then I also I made mention of the fact that these levels are actually intermediary, in the sense that one could serve as supply, and then subsequently in the nearest future potentially serve as demand. Okay. So I would use the concept of I would use the concept of a house, a story building. Say for instance now that you're on the last floor, and you're trying to make your way up. Now, before you get into the house, there is a staircase. Once you get into the house, you have the first floor. You make your way up, you have the second floor. So you see that while you were on the first floor, to get all the way to the second floor, you had to climb up, and by the time you climb up there, the second floor becomes your floor level. So invariably that now becomes what could potentially be a ceiling point, now becomes a floor. Do you understand? Do you understand?
I understand, yeah.
Okay, all right. So now in this case now, I'm going to take it back to the Aussie dollar thing, where we kind of like spoke about the entire thing here. So in AUD it's very very simple, right? It's very very simple. So we did. I think when we had this class, AUD was somewhere down, just trying to like retest the demand level before making its way up, as you can see, like so here. So let me just go ahead and like expand my screen so this whole thing will make sense. Anyway, the network here is always horrible, man. Like during this, when I'm making my videos, it's not as bad. However, whenever we're having classes, it's just horrible. Um, so this is the whole point here, yeah. Now recall that we had this supply level somewhere around here. Let's just go get over to the weekly time frame. So I show you guys something real quick. So you can see that from here, yeah, we had this supply level. Okay, this was the supply level that we were talking about earlier on, where I told you that the market had to come in here and then melted all the way back down. And then I told you that since this level had acted as demand level in the past, it will most likely act as demand level again, and that was exactly what happened here. Feel me? Yeah, and then
Yeah.
I did mention that even if the market falls out of the sky and then lands here, you don't just go ahead and click buttons up and down. You must have you must have a system and a structure. All right, you must have your code of conduct. How you do things. I mean, even if you had made some form of entry in here, you were not wrong. However, just that in the times where you're not certain, because at the end of the day, this is just probabilities, all right. So you can't really tell if the moment you get into a trade, you're gonna make money right off the bat. It doesn't always work that way, because the brokers have their own thing. So, and sometimes you could have some event coming up, like we had the like elections come up, and then we had like this spike up and down here. All right. So now on getting into this demand level here, the market just balanced out properly and then now bolted up. Now, ideally, what would happen here is two things, because this next model that we're actually talking about now is entries and exits. So practically, how do you go about executing trades like this? Okay, now this is that one example where we had like the market bolt out of a demand level without leaving any clues as to why he did that or what he would do next. So we had this drop here into this bar here, and then since this is even a lot better than the JPY pairs, which I think I'll use that one to explain the whole linear bounce method. So we have entry strategies that we use. So we have the counter trend line break and we have the bounce strategy, right? So I needed to go ahead and take note of that. So we have two in terms of execution here. We'll have the bounce, we have something called the bounce method. All right, so we have the bounce method, and then we have the counter trend line break. So with these two things now I'm going to give you the conditions to use.
Those are the what?
The two entry methods that we use, execution methods.
Okay.
Yeah. So say for example that you've done all your technical stuff and it's time for you to execute. You've gotten your directions correct, and everything is just going well, and then it's just time for you to just pull the trigger. And what are the things you look out for before you actually go ahead and click the button? These are things that we call what's called entry strategy. All right. So in this case here, yeah, it's very very simple. Now, one of the criteria to use a counter trend is the market has to flag. Okay, the market has to give a flag pattern in the sense that the market has to give you series of waves. So while pulling back into the demand level here, the market has to give us the characteristic of a downtrend, which happens to be lows and highs. Okay, series of lows and highs. So lower lows and lower highs, and I believe that by now you're actually able to count your waves. All right, you can count your waves properly and then know exactly what you're doing. So we have like a decent downtrend here on in this case here. So judging from the way this whole pullback thing is now, you can actually go ahead to use your counter trend line. Now, a trend line is particularly what connects the outermost point of a trend a trend that is the swings. Okay, the swing point. That is exactly what a trend line is, as you can see, like here. So this is clear. So we had like a downtrend here. We'll hide the high, this low higher, lower high, lower low, lower high, some form of equal low. Then for came on here to put in a lower high from here. So you can see that consecutively, the new lows created were always lower than the previous low, or rather the new highs created were always lower than the previous high, in the sense that because this is a high, this is a low, so every new high created is always lower than the previous one. Hence, this makes it a downtrend. Do you understand? So now you can see how we just went ahead to
Yeah, I
connect
understand.
the outermost points. We have the top here, you have the bottom, top, bottom, top, and then this was the bottom. All right. So this is exactly how we went ahead. So what we did was very simple. We just connected the three outermost points of this trend, and then just went ahead to connect the dots, and this is exactly what we have here. Okay. Touch one, touch two, touch three, and then we had the descent trend. All right. So whilst buying this guy, this was a kind of like concern for me, because I was thinking, I mean, there is a principle in trading that states that the third touch of the trend line always does the trick. So if I'm buying for any reason into this point, I have to be mindful of the fact that I'm approaching a supply level, okay, and then also I'm approaching a potential third trend line bounce, and the third trend line bounce usually sends the market, farthest in terms of reaction off of the trend line bounce, in the sense that you can see how you can see the magnitude of this bounce off of here. You had the first one here, it didn't really do much. Second one actually sent it into lots of pips. Now this third guy here is experiencing some form of hurdle here, because this is, he just dropped out of the sky straight into demand level. So this guy held him back. Do you understand? So now it came into demand level, and you know that we trade off of levels. Like we don't trade in mid range. We have to trade off of the level, despite the fact that we know the trend direction, we know every single thing. We still do not execute unless we see a reaction off of a level. So this reaction off of this level was a bearish setup, in the sense that we had like an engulfing pattern here. Then entries were made. Then obviously make it down. Now entries are made on lower time frame. Now coming to the demand level player. So the market came into weekly. Now, mind you, this is the weekly demand level. This is where the market reversed from in recent times. So it came on here, and if you look at the daily time frame closely, this guy did not give us like a decent wave pattern. However, what he did give us was a bounce. Okay, he gave us a bounce method. So now a bounce method is literally one that happens like this. You have a level. Okay, you have a level like this, like so, and then market comes in here. Instead of the market giving you your typical pullback, they'll practically come in like this. Do you get? Give it that wave pattern where it comes and slows down, slows down, slows down, slows down. Maybe fake out here. Maybe fake out here. Hold on. Maybe fake out here, then pull back in, then go. Now this is the typical one where you can get to use counter trend line plays. Yeah. Now it doesn't always happen that way. Sometimes the market just comes and just does this, and then bounces off. Now you can't use this as a counter trend line because you're gonna flop. You most likely enter a trade somewhere in here, and that's not good for your RR.
Yeah, the middle.
Do you understand me? Yeah. So this is exactly where the bounce method comes in the sense that you now look out for your counter your candlestick patterns, in the sense that if for any reason we are just dropping out of the sky like the JPY pairs would do, just dropping out of the sky without any single hint of reversal, what you now do is look out for, so there's something called drop base rally and drop base drop, and rally base rally. So this thing here is practically a drop base and then rally. Okay, so what you have here is market came right into demand level, then just kind of like flirted with level a bit, then gave us a candlestick that was bigger than the previous candlesticks. Now in this case here you have a bounce. I take it again. So in this case here you have the market just fall out of the sky like the JPY pairs would, and then just dropped into here, then flirted with level a bit, then gave us a bigger candle. Now you have a cluster of candlesticks here. Don't get me wrong, it's a cluster. Like what happened on silver now. And even following my YouTube channel for a while now, you can see that I called out silver right from the bottom of $26, which I think I could show you. So we had like a cluster here, then we saw that big engulfing candle. This was our key for entry. At the close of this candlestick, on the 4 hour time frame was the key for entry. Entries that made their stop are below here. Now why would I wait for a bounce at least? It's very, very simple. I need to see the market react off of it. I need to be sure that this level has held. And one way to be sure is that I must see a bounce like this. Do you understand? So once I see that decent bullish engulfing bounce, in this case I'm buying. Once I see that decent bullish engulfing bounce, entries will be made, their stops will be below it. It is very, very simple. Okay. However, in the event that I come here and then I now see candlesticks that just it doesn't give you any significant push to the upside, it just plays around there, plays around there, plays around there. Now this is recipe for disaster in the sense that the market is here to decide, and this thing typically happens around when you have a key red folder event like NFP, FOMC, CPI. I'm not really a big fan of trading the fundamentals, but I'm just saying that whenever you have these things happen, you should look at your Forex Factory or investing, whatever niche platform that you're conversant with. You may be having some form of red folder event just around the corner, which the market is waiting as a catalyst to now decide, are you going to break below here? Are you going to just go continue higher? Because it's sometimes the market wants to create that supply level for you. What it does, it comes here, plays around here, then you see a sharp move down, then you see it pull back to that level. Okay, and then continue down. It doesn't change the fact that the market is still technical. Do you understand me? So whilst the market is in here trying to decide, you have no business here. The moment you see a decent engulfing candle like pop up like so, that is your cue to enter. So now let's get back to the game. So back to AUD now in a nutshell. This guy did not actually fall out of the sky. Actually gave us a wave pattern, and even after the wave pattern, you can see the bounce method here. You can see the bounce method. So this is that bounce candle that engulfs 1, 2, 3, 4, 5. So particularly 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The previous 10 days was engulfed by one single candle. Do you understand? So this is an indication of buying pressure. Now, this would make sense if you don't already have a flag pattern to work with. Now, even if you have a flag pattern, now what the flag pattern helps you do is it helps you make like earlier entries in the sense that instead of waiting for this guy to bounce over. Now, if you had your entry here and your targets are maybe somewhere up here, your risk reward will not really make that much sense. In the sense that you had entered somewhere around here and then make it all the way up, now that is something sensible. Do you understand? Because at the end of the day here, and now risk reward is subjective in the sense that if I have $5,000 to risk on a trade and I'm using one is to, let's say for instance, maybe I'm using 1:1 or 1:2 risk reward, that is a risk one to get times two, and you on the other hand you have $200 and you're using a 1:3 risk reward. At the end of the day, I still make more money than you because capital here,
That's true.
because times two of 5K is 10K pocketed. Then you on the other hand times two of $200 is like 600. So you're not even anywhere near. So you see that RR is not as significant as capital is. Do you understand? So we have like an order of priority here. So to execute this trade will be very simple. Just go down to the 4 hour time frame, which is the time frame that I actually advise for you to execute your trade on, and you can come and see what's happening here. Okay, so in this case here, you can see that this was where the market actually started giving us some form of a flat pattern. Because if you had started from here to plot your counter trend line, you will not be wrong. However, okay, so this works as well. So you could have easily started from here to plot your counter trend and like connect the outermost points of this wave pattern, and then you will now wait and see, okay fine, once I see a decent break above here, 1 4 hour candlestick break above here, I'm entering. Now your stop has to come under here for structure's sake. All right, so in my mentorship program, I urge my people, whatever thing you're doing, and also on my YouTube outlooks, you always you really want to set your stops according to structure. I kid you not, you will have more peace of mind than trying to fit your stop loss into take for instance, you made an entry and you're trying to put your stops here, you get smoked like this. You can see that even
Yeah.
even
So for
even
example, in this,
yeah, I can hear you.
yeah, for example, in this trade now, this setup now, where would you have put your stop loss?
Okay, so now peradventure that say for instance I executed this trade here. Now, where I will put my stop loss is very simple. Okay, it's very simple. I will most likely put it somewhere around here, at this low here, somewhere around here at this low. Okay, now this might
So
be
how many pips is that?
that will be more or less. So I don't count it per pips. That's the thing. It's not, you don't calculate per pips. Do you get? It's not per pips because, like I said, RR is insignificant here. RR is not that big a deal. It's not that big a deal as people make it. Do you get? So it's not as big a deal. The bottom line is the trade a winning trade or not, and then how much do you have at stake? I rather have a sure 1:1 or 1:2 risk reward than have a dicey looking 1:3. Do you understand?
Yeah, I understand, but like this now, it could be up to 200 or how many,
No, it's just about 150
maybe 150 pips.
thereabout. Yeah. So practically executing here, to catch probably maybe 320 thereabout. It's still decent. You get? It's still decent. That's well over one is
Yeah, it's
to
still decent. It's still
yeah,
1 to 2. Yeah.
exactly. However, I'm still not.
So I just want to confirm. Yeah.
Yeah. So even
Yeah,
if
I can
even
hear
if
you.
you're if even if you're setting your stop loss, I will not advise you count per pips. Do you understand? I mean, pip count is good, but I'm not advising you go per pip, because if you're going per pip, you'll be too limited and you'll be too tight, and you'll not give yourself enough room for the trade to even materialize. And the last thing you want is to be right, and then get kicked out of the trade before
Yeah.
the market even moves in your direction. You feel me? So once you execute here, you must put your stops at least
Yeah.
where
So,
where
yeah.
where you know that normally the market will not get to there. Like even if it gets there, it would be maybe due to a news event or anything. And you can see that even the election, as big as it was, it could not break the structure. Do you get me? So that's just one of the things about setting your stops. So in this case here now, since you had
Yeah.
since you
Yeah. This one just spike. That's
yeah,
yeah.
So in this case, yeah,
Yeah.
since you had a flag pattern, yeah, it was quite simple. All you have to do was execute add the counter trend line break, 4 hour candle break and close. It doesn't matter if it is a bullish or bearish. Entries are made somewhere around here. Then stops come all the way back down. It doesn't even have to be this low. It could be somewhere in here. But the key thing is that give enough space between you, because you see now. Let me just let me clear the air now. You see, there's something called market manipulation, yeah, which is something I'll talk about, I think, in my YouTube video, or maybe subsequently as you go. These markets you see here, this drop here is caused by the big banks, in this case being the investment banks. You get the hedge funds. Think Berkshire Hathaway, think these guys, think Vanguard, think BlackRock. If you mean now, these guys have a ton of money to dump on one trade. You don't. Do you get me? And they have access to data, in the sense that at the end of the day, the market is moved by mass human psychology. They know that you most likely put your stop loss somewhere around here. Especially those guys that they call them ICT traders or SMC boys. They most likely put
That's where most people put it.
exactly. You most likely put their
Yeah.
stops here.
Yeah. Yeah. Yeah.
And where do you think all these spikes ends up? It ends up somewhere around there. It doesn't change the direction. It just comes to play with you guys. You know that some people will put stop losses here now, take them out, and then now continue. Do you understand? So people's stop loss is technically a take profit to them.
Yeah.
So because they have access to data, you don't have access to that much data, but they do. So they can see
Yes.
where majority of the average traders will put their stops, and then spike them out, and then now moving in their initial direction. So in this case here now, you just have to give enough room. Okay, let me make it simple this way. Where you would originally put your stop loss, add like 20 pips to it. I think that'll make more sense. So say for instance now that you had plans to put your stops here, you
Yeah.
can add 20 pips of SL, maybe push it further down for safety's sake. You feel me? So now that way,
I understand. I really understand.
exactly. So
I understand.
yes,
Yeah.
so your market has enough, your trade has enough room to just ripen up. So that's just that for this guy, and it was very simple. You always has to be a counter trend line break when you have a flag pattern like this. Now, let me show you the one where we didn't get the luxury of a flag pattern, so we had to just go with what we had. All right. So now, in this case here, let me show you something real quick where we have which one would I use? There was one pair that just moves in a very funny manner. So let's use silver now. Silver in on this case here now is so now for for silver now, yeah, it's very simple. So the case here for silver was this. All right. Um, So the thing about silver and the Japanese yen pairs is you will not get that without that wavy move every time. Do you get? And you most likely need to rely on your bounce method. Okay. So now I called out silver all the way from this very bottom here, from this point here to the upside. Now, first of all, I did my analysis on the weekly time frame. I could see that, overall the time frame like the major time frames here were we were pointing bullish. All right, in the sense that if I come on the weekly time frame, I can see some form of inverse head and shoulders pattern playing around here. Okay, so in the sense that this is how it looks here. So this is this head, shoulder, neckline break. So this was more or less a bullish pattern. Okay. Now I saw that, and I knew for sure that, okay, fine. If market has spent maybe 100 and whatever amount of pips in here, maybe 800 and something pips in here. Once you break, we have to give the equal amount of pips anyway. So I knew that invariably whatever happens here, we're actually due to come into this region at least $35 per ounce for silver, and that was my private target on silver, which I called out on YouTube, and they banked it. All right. So now on that note now, so first things first, we've identified chart pattern, which is on weekly time frame, and you have like the market now came in to create a demand level, in the sense that this was the first bounce. Now, by the time you measure this, there's something called Fibonacci to which I'll be talking to you again in the subsequent videos, how to use your Fib to actually know when a demand or supply is ready. All right. So now in this case here now it's very very simple. So we'll highlight this is the demand level here, then this is another demand level here. So now so
Yes.
can you hear me?
I can hear you.
Yeah, all right. So in this case now, yeah, we have something very very simple here. We'll have this. This was the first kickoff. Now there's something called impulsive move and correction, which is another thing I'll be talking to you about. So now you can see that this whole impulsive move here, this whole breakout, if you measure it, if you parate it, this pullback is not enough for it. Do you understand? So we have three kinds of pullbacks. We have actually four. So you need to learn how to count your waves. So we have the first pullback here, which doesn't always do much. The second one sends the market away. You have the third one, which is always good. And the fourth one is when the market is going for that bigger pullback. Do you understand? So now, in this case, now once you bring out your fib tool and you have to measure from swing low to swing high. In this case here, this is the most immediate swing low. This is the most immediate swing high. So from swing low here all the way to swing high, you can see that the market didn't even come into any. So one of the ways to know that a pullback has ripened is using the Fibonacci tool. You can see that when we drew from swing low to swing high of the first pullback, it didn't that much. But when we extended it to the second pullback, which was even further, you can see the market came right into the 0.600 between these demand levels here, which signifies that this is the actual midpoint, the ideal midpoint for anything you're doing. Do you understand? So this just signifies that this is the ideal midpoint for anything that you're doing, as regards trading. Okay. So now in this case here, now this was the first, the first bounce we had here. This was the hint that this place had come on here to create a very solid demand level. And by the time we now scale down to the daily time frame, so what we had to do now was wait for the market to come back and test that demand level for us, which was exactly what happened here. So you see, after creating that demand level, and watch what happened. Now you can see what I explained earlier, where the market creates demand level. It just comes here, slows down, cluster, engulfing. Do you see? It breaks above there, come back, test it, cluster. This is the cluster. This is day one, day two, day three, day four, the fifth day, bam. This is engulfing. Now this is buying pressure engulfed 1, 2, 3, 4 previous days. Alright, so this is the buying pressure. Entries are made, your stops are below, and you write the guys to the upside. Do you understand? Yeah. Do you get me?
Yeah, I understand.
Yeah, likewise here as well. We just dropped out of the sky, then came on here, slow down, engulfing. Now, if you had waited for counter trend line to enter this trade, now you most likely would have entered the trade somewhere around here, as compared to entering here. Do you understand? So you see, the concept of the forex market is that it is very dynamic, and you need all the arsenal. You need all the weapons you can get, all the weapons you can get in your arsenal, because the market will give you any pullback. And you see now, since you can use counter trend line here, you can use the bounce pattern and use the counter trend line here, because in this case now you have a flat pattern, in the sense that you could have easily done this. All right, you could have easily plotted. I think to be clear, once I scale down to the 4 hour time frame. Okay, so you can easily hold on, let me show you something real quick. So in this case here, so since we couldn't use our counter trend line here, we opted for the bounce method instead. You can come in here, so you could have two entries. First entry here with the bounce method, you're writing this guy, and the second entry here is simply this counter trend line here, this counter trend line break. All right. So now mind you, when you're plotting your counter trend line, now this is the thing. You see, this what this guy did here was coming to create another demand level, in the sense that you have first bounce, second bounce here. Okay. Now, can you hear me?
Can you hear?
Yeah. So now, what this guy did here in this case was coming to create you know, um, first bounce, second bounce. Yeah, all right. As far as this demand level is concerned, do you understand? So, in this case here now, it's very very simple. So what we had to do was, since we have one entry here, okay, and it's already moving in your favor, what do you need to do is strike another entry. And now in this case, now it's very very tricky because this pullback here came back after, it had already broken out. So this is why, whilst drawing your contract, you must be very careful as to, you must allow the market time, right? Give the market time, let the market do everything it has to do as far as the market. So this contract is probably like your helmet. You get. So if you had drawn your P like this, would have gotten smoked, because now, entries are here, then stops are here, somewhere below here. That's large. You get. For silver, that's like, because the pip count on silver is huge. So now that's large. So what you want to do is allow the market do everything it wants to do. All right. So you can actually plot it this way. Allow it do everything it wants to do. As far as once it breaks above here, it can enter. And now, once this entry is done here, now you can see that the market just keeps giving. And then also it did the exact same thing here, where the market will come here, create another demand level. Now remember, how the market shows you a sign of demand is that after that accumulation comes a sharp move. So this is it, sharp move from there. All right. So what you want to do is to wait for the market to come back to that point again, and you buy. Do you understand me? See stuff like this again. The market came on here, created this demand level, then busted out. See what the market did here again. Now, on pulling back, it did not give us any wave pattern. Instead, it just came to accumulate here and then bounced out. So you see, you have to master how to use both entry methods so that you don't get smoked in between a profitable trade. Do you understand? So you can see that from here to here.
For example,
Yeah,
I have a question.
yeah.
Like when the price touched
This blue
the
bar.
blue zone,
Yeah, up
yeah.
here. Yeah.
So there you didn't take any sell trade because it's in a long term
So for
trade, like trade.
So for my kind of trader, I go with the trend. Demand and supply levels are effective when you go with the trend.
Okay.
The effective once you go with the trend. So I rather go with the trend than do anything otherwise. So in this case, I'm just looking for buying opportunities. Do you understand?
I understand. Yeah.
Exactly. So that's exactly how we need to, look at things from a broader standpoint. And I kid you not, by the time you take these things into consideration here, you get to discover a big change in your trading journey. And then you see that majority of the mistakes you've been making before could have been avoided. Yeah, so that's just that for the entry. So I think we will probably have to touch this again for the second time before I move on into other models. So do you have any questions for me?
No, no question about what you said. So I think at the end I have just one question.
Okay, what's that?
So I just want to ask, like, what was the average number of trades you take weekly?
Weekly?
Yeah,
Did you say
the average
weekly?
number.
I could go an entire month without a
Yes.
trade. Yeah,
So what will you be doing?
just watching the trades I placed earlier. like like I've done.
Because one of the issues, one of the issues I'm having is like having patience, just watching without doing anything.
No, that's the whole process about trading here. You have to be patient. You see me Desmond somewhere here. I could call out if you watch my YouTube videos, which I suggest, which I think you do. I probably call out maybe 10 to
I do.
15, 10 to 15 trades, bro. But at the end of the day, it's just like one or two that I take, man. If I go on there talking about one pair, I won't get as much audience. You feel me? So at the end of the day,
Yeah.
I'm killing two birds with one stone. I'm catering to as much people as possible. But then I'm also letting you guys know that okay, fine, this is what I do for a living. In case you want to hit me up, do you guys? So it's very very simple. It's very very simple. You see this guy here? I caught out this pair. I think somewhere around maybe August. Yeah, August, and you can see just one trade call. Assuming you get this right in a month. You don't need any more trades though. I hope you know, guy. Slap better $10,000 on this trade, guy. You're good for the quarter. Do you get it? So that's how I like to think about my trades. I'm not a numbers. I'm not a quantity guy. It's quality for me. Do you get it? Imagine getting this right in a quarter, like bro. Imagine getting this one move right in a quarter, literally August to October. You're good, man. Because that's
Yeah, I saw someone that entered gold since 10th of October,
do
and
you understand?
till now,
Do you understand?
yeah, just
And
one trade.
and and that guy will keep milking while you're like out here chasing ADCAV and all these crappy pairs.
Yeah,
Do you understand? So imagine say you hold better 10K like this, slap this guy for your guy, bro. You you
that's what
probably
I'm trying to work towards.
you probably lock up for the year, man. Like guy, screw any more trades. I'm done. Jiggeds. But that's the advantage you have with me is because the trades I take are very very limited, man. And I'm not here to pick 30 pips, bro. I want to make the move. I want to squeeze the entire pip count. Do you understand? And that's the whole thing. Like, bro, I kid you not.
That's
Like, see, trading is crazy. If once you get it right, it is crazy. Like, you will not believe it, man. But even Niger guy, so you don't believe him. I think you know what I'm talking about. So
yeah, that's yeah.
it's crazy. You see this one move here. I think this, but people think that this was the highlight of my year. But this has never been. This was not the highlight. Do you understand? The highlight has always been on the yen pairs. If you watch closely, my most successful pairs are the ones that you will not hear me talk about all the time. Do you understand? I'm not saying that I don't have
Yeah, they really move well, very well.
exactly like those guys. I'm telling you, once the pairs are pulling back, they are pulling back for real. Intentional pullback, or like they pull back out of like you can see the pair just fall out of the sky. You go see a reversal. Do you understand? You know that it's just a pullback. Likewise, when they are moving in your direction, my bro, and they move in such a way that you won't even get a chance of a re-entry because it's so linear. It's not like wavy; it's just linear. Do you get? So
Yeah, that's true.
you two can do this, man. Bro, like you can knock out trades like this, knock out a trade like this, and for someone who was I believe a corporate job or something, imagine just having maybe out of your paycheck you slap like 5K on this guy and then just go about your day, man. So whilst you're in the office, this guy is in the office. You're in the office. This guy also is in the office. You feel me? So the only thing you're combating is obviously brokers with their commission and sub fees, and that's it. But bro, you make so much money. Like I feel like I'm talking to myself actually, but yeah, you make a ton of money once you get your trading right because there is no cap to how much you can make here, man. There's no cap. It's crazy. So imagine that one entry you had there, all their election and all their record rubbish, just it doesn't change anything, man. You just write to get to the upside, and this is just like half of the move. But I still believe that once we clear this 35K, this $35 an ounce, we are actually en route to $48 per ounce. I guess. So you can imagine one more leg to the upside here. So even if you missed every other move, at least this one was put back for your pocket. Q1. At least you can start the year sweet. Do you get? So that's just the whole. I'm not here to trade everything. I find the pair that has the potential. Find the pair that you can squeeze life out of. That has nice sweet potential. Not the one that you be having heartaches at night. Do you get? You know that this guy is a very very scarce commodity that is in demand. People always see the thing with investors is that once they panic, they don't go far away, oh, guy. They just find all these assets that are like safe haven. You see gold, you see silver, all these things, tin. They just go to oil as well. They just go to these things that have like a lower chance of making them lose their money, and then just execute them. You know, so that's just how it is. It's very
Because I
decent.
noticed now of recent, like the GU, EU, they don't really move like maybe 200 people.
And you see, the market has
Again.
there's something called seasonal tendency where there's a pair for every season, man. But that's like another thing entirely, because the US dollar is not moving every time, bro. That guy is mostly stuck in the range. So you can imagine not having a trade because you're waiting for dollar guy. You feel me? Meanwhile, you can just ride on investors' fear and greed index and just make money. Likewise, S&P 500. See, I called out S&P, I called out Nasdaq, I called out US 30, I called out a lot of pairs. But you see those guys in that group, they will not take it. You know why? Because they don't see the money in it. And that's the thing. Like my goal is to broaden your mindset, open up your eyes to see, like, bro, you're not glued to GU or EU. The market is full of pairs, full of nice decent pairs.
Yeah.
Do you get? Your own is to master your technicals. What can you do with your technicals? Once you get it right, every be it GU, the brother of EU, anything that comes, the cousin of EU, bro, you execute, you make money. Do you get? That's why I see me come election, no election, Great Depression, whatever thing they call it. I'll make money, man, because I'm not here to dabble in and out of trades. I execute and hold. See, because I also have a job, guy. I have a job as well. I have stuff I do here as well. So I'm not gonna be on the screen 24/7. There's very very little, light. There's no chance. You get? So I will just execute. So my so,
Yeah.
so my so my trading technique is also working. Is gonna be working for you as well, because you release your interference with the market, in the sense that all these things could have happened maybe while you were at work, and maybe you come back and say that, okay, fine, you're here in profit.
Yeah.
Whereas if
One
you
of
were
the
here,
issues, one of the issues that
yeah, whereas if you were here seeing this spike down, bam, hey, I entered the wrong pair. Oh. Meanwhile, this was just a pullback.
yeah, that's one of the issues I'm having because
Eh,
I have access to my PC.
Exactly. No, I mean, having access doesn't change anything. You shouldn't be having access to the phone I used to trade. That is the thing. Execute your trade on your phone and leave it at home, man. That's the trick, I use. Do you guys? So if you have two phones, just execute and then just leave that guy at home, and just go about your day. You know, that's just it.
Okay.
That's just it.
Yes, I think the next thing will be trade management. That's where
Oh, of course,
we
I'll have to
talk
take you
about
take you on to trade
like
management as well.
trailing.
Yeah, yeah, we'll scaling into trades as well, all sorts of things.
Okay.
So yeah, it's I mean, it's all for your own benefit.
Yeah,
And
because
I can hear you. I can hear you.
yeah, you wanted to say something.
No, I was going to say that at the end of the day, the biggest difference between my that I have noticed with all my mentees is that uh, nobody practices as much. You can imagine me as a person that already knows the game. I practice as crazy. Then how much more you that you're just trying to learn, but you don't go back to do your homework. You rather just be online and post every day and just waste time. You get? Why not invest that time? I kid you not. If you give this stuff solid 3 weeks, if you give this stuff a very very decent 3 weeks to a month, my bro, you make so much money, man. Like, you'll be so good. Do you get? So that's just the difference here. You know. that's just the whole difference here. So
The connection is bad.
no, it's calm. So I believe that I've been able to touch certain aspects that are actually necessary. So in our next episode, next module rather, we'll be talking about. I think I should take you through another video on bounce method. So this is just one pair. I'll take you through the rest of the pairs that can use bounce method on, and then also how to go about it. All right. So I have this
Yeah, I
video.
can hear your last statement.
I'm saying in our next module. Just give me a sec.
Yeah.
Just give me 1 second. Guys. So in our next module, that will be trade management. All right. But I like to like touch on this entry and exit, maybe like with like one or two extra videos before we move on, because this could make or break your trading. You could get the technical right, and then still lose the trade. It's very possible. You get. So let me just
So,
yeah, let me just run that down, and then I have the two videos. I've not had time to sit and edit the videos, so I have time to just get them off the bat, so I can upload them and then send you the link. You can always rewatch anytime you want.
okay.
All right, man.
All right. Okay.
How's John?
Yeah, it's fine. It's good. Yeah, still need the forex money to make everything perfect.
No one Niger guy. No one I know. You don't know. All right.
Yeah.
All right, man. Take it easy now.
So, my plan is, for example, if I'm profitable with this,
Yeah.
then I'll just come back. Yeah.
You come by Niger. Why? Well, the thing here is this.
The weather is good, and
Anyway, that's good. But you better live there. But the benefit here is this: you can come back home and then invest this money somewhere. It's easier. It's
yeah,
people don't understand, but it's actually easier to grow wealth in Nigeria. Like, bro, it's so easy, man.
yeah,
It's so easy
yeah, very
compared to
easy.
those countries where you have to be. Oh my days! But in Nigeria, there
Yeah,
is so
I,
much.
I I understand what you're saying.
Yeah, like there's so much you can get by. Like you can just get past certain things here, man. You can get away with a lot of things here. Unlike the EU countries where, bro, first of all, the racism there is mad.
Yeah.
So it's
Even yeah, if you trade, you have to pay like 30% tax on the return from trading.
imagine. I say you guys run your own pillow kill. You go to pay 30%.
Yeah, yeah, yeah. Maybe use Nigerian.
For Nigeria, who come build me for my house? It's crazy. All right, so that's just the thing here. So
All right.
in our next class, we touch that. We touch
All
that.
right. Thank you very
I
much.
might take it easy now. It was nice talking. You can end the call from your end.
Yeah.
All right.